If you walked into a bank today and deposited $1,000, you'd probably assume that money just sits there, safe, waiting for you. It doesn't. Within minutes, most of that money is legally allowed to leave the building and get loaned to someone else, a stranger. Someone buying a car or a house or starting a business. And here's the part that sounds like a mistake but isn't. Your bank statement will still say you have $1,000 in your account. So does the stranger who just borrowed it. That's not a bug in the system. That's the system. And once you understand how it actually works, you'll never look at a bank account or a money printer headline the same way again. This is how banks create money, legally, out of nothing. To understand how this works today, we have to go back a few hundred years to a much simpler problem. In 17th century Europe, if you had gold, you had a problem. Gold is heavy. It's easy to steal. And carrying a bag of coins across town to buy something wasn't just inconvenient, it was dangerous. So people did something practical. They took their gold to a goldsmith, someone who already had a secure vault for storing precious metal, and left it there for safekeeping. In exchange, the goldsmith gave them a piece of paper, a receipt. It said essentially, this person is owed X amount of gold held in this vault. That receipt was safer to carry than gold. It was lighter. It was easier to trade. And eventually, something interesting happened. People stopped bothering to redeem the paper for gold at all. They just traded the paper directly. If I owed you money, I didn't hand you gold. I handed you the receipt. You trusted that the receipt was worth what it said because you trusted the goldsmith's vault. That receipt was the first paper currency, not government issued, not backed by a central authority, just a private promise backed by gold sitting in a back room. Now here's where it gets interesting. The goldsmiths started noticing something. Most people who deposited gold never came back for all of it at once. Some came back for a little. Most never came back at all because they were happy just trading the paper, which meant most of the gold in the vault was just sitting there, unused, doing nothing. And a goldsmith looking at a room full of unused gold started asking a very profitable question. What if I lent some of this out to someone else for interest and just didn't tell the original owners? As long as not everyone asked for their gold back at the same time, nobody would ever notice. This is the exact moment right here where modern banking was born. Not in a boardroom, not in a government building, in the quiet decision of a goldsmith realizing that trust could be leveraged. Let's fast forward to today and walk through exactly how this same principle works inside a modern bank because the logic hasn't changed. Only the scale has. Say you deposit $1,000 into your checking account. Your bank is required by regulation to keep a portion of that money on reserve, meaning available in case you want to withdraw it. Historically, this reserve requirement has ranged anywhere from around 3% to 10%, depending on the country and era. For this example, let's use 10%. That means your bank keeps $100 on hand. The other $900, the bank is free to lend out. So it does. Someone comes in for a loan, let's say, to buy a used car, and the bank lends them that $900. Here's the part that breaks most people's mental model. Your account still shows $1,000. You haven't lost anything. You can still spend it, withdraw it, transfer it. But that same $900 now also exists in the car buyer's hands. $1,000 just became $1,900 of spendable money in the economy, and we haven't even gotten to the interesting part yet. Because what does the car buyer do with that $900? They pay it to a car dealership. The dealership deposits it into their bank. That bank now holds a new deposit of $900. And under the same 10% reserve rule, it keeps $90 on hand and lends out the remaining $810 to someone else. That $810 gets deposited somewhere else, and the cycle repeats. This is called the money multiplier effect, and it's not theoretical, it's precisely how modern banking is designed to function. Under a 10% reserve requirement, that original $1,000 can theoretically expand into as much as $10,000 of total money circulating through the economy, all traceable back to a single deposit. None of this involved a government printing press. No new physical currency was created. This is money created entirely through lending, through the simple mechanic of, you can spend what you deposited and I can also lend most of it out at the same time. Economists call this fractional reserve banking because banks only hold a fraction of deposits in reserve. The rest is working out in the economy, generating interest. And here's something that might surprise you. Most of the money that exists in the world today wasn't created by a central bank or a mint. It was created exactly this way through the ordinary, everyday act of banks issuing loans. Now, at this point, you might be thinking this sounds like a scam, or at the very least, incredibly risky. And for a long time in history, it was. Before modern regulation, this exact system caused something called a bank run. If enough depositors got nervous, even for a rumor, even for no real reason, and everyone showed up on the same day demanding their money back, the bank simply couldn't pay everyone, because most of that money wasn't sitting in the vault anymore. It was out in loans. This happened repeatedly throughout the 1800s and early 1900s, and it hit a breaking point during the Great Depression when thousands of banks failed and everyday people lost their life savings almost overnight. In response, governments built two major safeguards that still define banking today. The first is the central bank in the United States, the Federal Reserve, which sets reserve requirements, monitors banks, and acts as a lender of last resort if a bank runs short on cash. The second is deposit insurance. In the US, this is the FDIC. It guarantees that even if your bank fails, your deposits up to a certain limit are protected by the government. This single change is largely why bank runs in the dramatic 1930s sense essentially stopped happening. People no longer need to panic and withdraw everything at once because their money is protected either way. So the system isn't reckless. It's regulated, insured, and monitored specifically because everyone involved knows the mechanic we just walked through is inherently built on trust, not on gold sitting in a vault. The core truth doesn't change though. Banks are legally allowed to lend out the majority of what you deposit, and in doing so, they create new spendable money in the economy. It's not hidden. It's not a conspiracy. It's published economic policy, taught in every economics textbook. Most people just never had it explained clearly. So why should you care about any of this? Because almost everything you interact with financially, your savings account interest rate, your mortgage rate, why the Fed raising interest rates makes headlines, all of it traces back to this exact mechanic. When a central bank raises interest rates, it's making it more expensive for banks to lend, which slows down this entire multiplying cycle we just walked through. Less lending, less new money entering the economy, which is typically done to slow down inflation. When rates get cut, the opposite happens. Lending gets cheaper, the multiplying effect speeds up, and more money moves through the system. This is also why the phrase "the Fed is printing money" gets thrown around so often, even when no physical currency is being printed. Most new money in the modern economy isn't created by a printing press at all. It's created exactly the way we described, through lending, deposits, and the multiplier effect, scaled up across thousands of banks simultaneously. Once you see this mechanic clearly, headlines about interest rates, inflation, and money supply stop being abstract news jargon and start being something you can actually track in real time in your own bank statement. So the next time you deposit money into your account, remember, that money isn't just sitting there. It's already out working, multiplying through the economy, one loan at a time. And this exact mechanic, deposits, reserves, and lending, is also the hidden foundation behind something almost every working adult depends on: your retirement account. Because the way your 401k is structured and why pensions largely disappeared from American jobs traces back to this same fundamental relationship between banks, trust, and risk. That's next.